Hello and welcome to the Harwood Report for December 4th, 2017. I am Keith Harwood, the founder of Trade Academy and the host of the Harwood Report. Let's go to the normal disclosures here. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. None of this should be considered a trade recommendation. All of this is just the way that I am looking at the market for myself. Consult with a financial professional before executing any trades. Options have risk. I'll go through the normal highlights. Equities, the big indices, obviously. Bonds, TLT is actually kind of interesting this week, I think. Gold has been interesting the last couple of weeks, especially with the way the dollar yen's been working. And obviously, oil is another big one right now. So there's a lot going on in the markets right now. So I'm just going to get right into it here. We'll start with fear and greed. Still showing greedy. The market has bounced back a lot from where it was on Friday morning when everybody thought that the political situation was going to be a disaster, and it turned out that was just really bad reporting. Yes, there are some potential problems there, but it's not a slam. It's not the issue that everybody thought it was when Flynn's stuff first came out. Tax reform then caught through Friday late, and that starts really pushing the market to new highs, particularly the small caps. So without any further ado, let's go to the charts. All right. So first off, S&Ps. Saw that move on Friday. Big break all the way down just below the 10-day moving average and then bounce back. Let's be honest, guys. There's a lot that happened over the last two trading days between Flynn and then this. So now what I'm thinking is that this is just, it needs a breather. It was really volatile. Traders need to take a little bit of a break. And what that means they're doing is they're taking off some of their riskier positions. That's the Qs. They've been the leader. Friday was a tough day for them. They did get the bounce back. Today looks rough relative to the rest of the world. Part of this is driven by semiconductors. You can come in with any of the normal names, NVIDIA, Micron, AMD. They're all down right now. SMH looks weak. Once this reaches that level where buyers come back to the market, where SMH buyers are coming back in, that to me will be the bottom for NASDAQ. Until then, I expect to continue to see this little bit of rotation out of NASDAQ, or at least a little bit of fear in the NASDAQ on the whole. So algorithms will continue to reduce positions in NASDAQ and extend positions in small caps. See small caps trading at this sort of extreme high. It helps keep the S&Ps tethered when you've got sector rotation being the driving force of the market. Dow Jones has actually been one of the better performers now after having been a little bit of an underperformer through this period. Bam, one full week and it just rockets. So Dow Jones is now looking strong. That sort of makes sense. That tends to be the big name companies, and people tend to go to big name companies when they're a little bit nervous about the market. The examples would be, Goldman Sachs and whatnot. Apple's been a little bit of a pullback because it's part of that tech sector. So all in all, what I'm watching for right now, before I get too excited about anything tech or anything sector-wise, is where can I find a buyer of SMH? And then that would lead me to say that this sector rotation right here is coming to an end once this pulls up. Sorry, it's going a little slow right there. Okay, so we can see here, this is the ratio between NASDAQ and IWM. So Qs versus minus IWM. It's just not a ratio, sorry, it's a spread. Qs were trading at about $8 over IWM. Then Qs got a little bit of consolidation while IWM started to catch up. Now IWM is actually over the Qs because of tax reform. Oftentimes when we come out of this rotation, it's IWM stable with NASDAQ rallying. So we'll see last time that this happened, there was a pullback in NASDAQ. It chopped back a little bit, and then it started to grind higher while IWM grinded a little lower. Same idea down here. NASDAQ had the pullback, then small caps stable while the Qs rally. So I expect to see something similar to that at some point. I don't know if that's going to be today. It's probably in the next week or two. So with that, I'll consider some potential structural type trades where I look for NASDAQ to rally $5 with the small caps unchanged into the year end from here. But until I see the SMH start to find a buyer, I'm not going to necessarily get aggressive with that because this could, this could be the time where finally the NASDAQ break turns into something bigger and it drops down to, 149, in which case I need to be based upon, I need to be setting my bullish overall structure on a rally from that 149 base as opposed to from this current 150 153.5 base. Sorry. So that's really what I wanted to point out here on the Nasdaq versus small caps here. TLT is another big one on that sign. So when it looked like the political stuff was a problem, massive rally in TLT, pulled back a little bit here. It's just doing an inside day right now, kind of chopping, but I do think that we're going to see TLT really break. And part of the reason is because dollar has been firm. Tax reform should be bearish for bonds, bullish for yields. And financials have been running based upon tax reforms and these increased yields. So that gives me my first real idea here right now is going to be in TLT on something that I can just do today without having to worry about some of the other stuff. So if I go to TLT, volatility wise, it's a little high at 10.3%, but the range is 9.3 to 11. It's not a big ranging volatility. When we look at S&Ps, the low is around 7 and the high is around 10.5. So just to get a little bit of perspective, yes, volatility is a little high at 10.3%. But it's not so far out of whack that I can't do anything, especially since realized vol has been around 11%. Knowing that some of this stuff could take a little bit of time, I also like having a little bit of time to put on this trade, and that actually really works well with this January of 2018 stuff. So if I'm looking back at this chart, technical wise, I wouldn't be surprised to see us press back here below 122, take out these lows over the course of maybe the next month and a half. If I go into Jan, I can buy something like the 124 puts for 83 cents. That's really cheap at 9.5% vol. If I want to reduce my overall cash outlay, I can do the 124, 121 put spread for 57 cents. And that actually fits really well to me. If we go to 122, that's worth $2. If we go any lower, it can get to all the way up to $3. So there's a lot of leverage there in the 57-cent range. So that's what I'm looking at first, is the Jan 124, 121 put spread for 57 cents in TLT. Let's go back to the charts here and get into the dollar a little more. Because dollar yen is another key element here. And it always has been for me. Dollar yen has firmed. It is above all the key moving averages now, except for just kind of playing right now with the 50-day. So it pulled back below the 50-day after opening above it today. It looks to me like TLT is going back up to here, 114 and change. Or sorry, USD JPY is going back up here. We had the MACD cross here, occur late last week. Looks like the dollar yen should start to firm again. Again, that fits with tax reform. It fits with some of the other things that are going on the fundamental basis. So I actually don't see a problem with leaning towards following the trend here in dollar yen. And that puts me into a bearish gold bias. Gold is pressing near the lows. This is held a few times here, just about 120. I don't think it's going to hold this time. If dollar yen pushes back to 114.5, I could see gold really tank here. We could be $4 or $5 lower in quick order. When I look at the volatility of GLD, it's not particularly expensive. In fact, it's about as cheap as it gets at 9%. Realized vol has been closer to 10%. This is a great opportunity. Implied volatility below realized volatility, and basically as low as it gets. And again, we're looking into the beginning of the year getting really cheap volatility. This is hit a little bit because of the holiday effect, but I can again go to January of 2018, and we can see that on the downside here, options like the 119s at 73 cents are pretty cheap at 9.3%. There is a put skew that's not normal for gold. So the way I like this is, again, in a put spread fashion, because if I get the 119, 116 put spread for under 50 cents and we get that break to 116, this is worth $3. So because of the way the skew is structured, and because 10% vol is higher than we would probably be on a move down there, I do like the put spread as my way to play my directional bias in GLD and TLT. If I was going to look for something with a little bit more of a directional trade without doing it as a spread, I would actually go into the miners. First, I'll stop by silver and just notice that this is already down here near the lows. So this is already kind of making new ground here outside of this little short time period where we were down around 14.5. And again, this I wouldn't be surprised to see us down there. Volatility is not as cheap in silver, though, as it is in the gold miners. So gold miners pressing against those lows the same way gold is. Looks like 21's in the cards, and GDXJ have broken through those levels, and it looks to me like 29.5 is in the cards. GDXJ gets interesting as a result of that, because GDXJ vol at 24% is very cheap. GDX vol, same sort of idea. It's very cheap here at 18.8%. But a $1 move in GDX is about 4.5%, and a $2 move in here is 7%. So I get a little, it's kind of the same amount of juice, I guess, in both. But GDXJ, sometimes you get that big liquidation event, especially with Gold Week. These are the companies that could have bankruptcy risk, the junior gold miners. When I look out here, it's again this January term. It's just mispriced to me. Notice that the front end of this is actually not more expensive than the back. The reason behind that is that realized volatility has been lower here, 18%. So remember, gold volatility was a little higher than implied. This gold volatility is a little lower, but I think we could have a liquidation type event, which makes me want to look for an outright long, especially with volatility as low as it is. So there was a big trade here today. Decent sized looking buyer look on the January 30 puts. I think that's actually a really good way to play this. I can get these mid-market around 61 cents. It makes sense to me. If I'm looking for that move down below 29.5 and then start to maybe accelerate beyond that, this could get really interesting. So for gold getting ugly, move down towards 29 and potentially lower, that's where I like the junior gold miner puts for 60 cents. If I just want to play something that is a little bit higher probability, it's probably staying with the GLD side where I can play with the put spread and take advantage of the skew and everything else there. I'm going to go over oil next. So we kind of covered all this. General bias is a little bit bearishness in precious metals and seeing some good opportunities to execute that idea through put spreads and GLD inputs and GDXJ. When I go to oil, we've had a little bit of a pullback today. We're back to the 10-day moving average. This is a perfectly normal type pullback in this bullish trend. 10, 20-day moving average retest before break the next leg higher. This has finally brought XLE up where probably it should be. Now it's starting to break out above the previous high there, which was $70.47. We're now above $70. In the past, when I've looked at XLE, it's been really cheap vol. Right now, it's not cheap. 15.5, almost 16%. So for me, this breakout's kind of happening, and I've got some calendars on from last week where I was buying the D's 29th and selling the D's 15th. I think that's a good way to play this because it realized vol being between 10 and 14%. Why would I want to be long 19% in December? Okay. So again, I think the calendar type play makes sense. January is clearly the cheapest to me right now. This January term right here, again, it gets past the holidays, it gets to new money allocation, and I don't have to worry about slow markets through Christmas and New Year's. So if I'm looking for anything here, I do like, let's just set the market vol to implied here, something like the January, where are they? The 72 calls there for 76 cents, and against it potentially selling December 22nd, 72 calls for 34 cents. So that gets me to about 42 cents. So that's just a fourth idea there. I don't want to give it away too much more. The rest I'm going to do in the premium newsletter product that will be going out shortly, but I wanted to give you guys a sense of what I kind of look at here. So OIH is very similar to XLE. I'll talk about that in the newsletter as well. And I'll go back and talk through more ideas in SPY, the Qs. I mentioned that the Qs, I was looking for something maybe structural where I'm long the Qs and flat to short IWM to pay off the theta. I'll play through that a little bit for the premium subscribers. So speaking of this, that's the Harwood Report. It's free for a month if you're interested. It's a great time to do it. We're going into the holidays, kind of test out some stuff. And then after that, it's only $49 a month. It's actually very cheap for the amount of content that I put out there. But I'm trying to help some people out here, and hopefully that leads to more, some good stuff for everybody involved. So if you're interested, I'll talk more about calendars, verticals, everything else in some of these names. Go to tradeacademy.co/Harwood Report to sign up. And again, you get that first month for free, so there's no risk to you. Contact me, Keith, at tradeacademy.co. Call me 312-600-8004. Emails are usually the best way to get a hold of me, but I'm happy to take phone calls if that's what you prefer. Have a great rest of the week, folks, and we'll talk to you next week for those that don't sign up for the premium report. And for those of you that do, look for that newsletter here in the next couple of hours. Thank you.